Hello and welcome. I'm Lucy Walker and I'm a Financial Services Regulatory Specialist here at Guildhall Chambers, and I'm an expert on the Consumer Credit Act. It's a truth universally acknowledged that anything connected with the Consumer Credit Act is deeply complex and takes a very long time. It was with some surprise then that practitioners were confronted with the policy statement that was published by the Treasury on the 18th of May 2026, which contained detailed objectives for reform and a much shorter time frame for reform of the Consumer Credit Act than anyone had previously envisaged. Therefore, in this webinar, I'm going to talk about the proposals for the reform of the Consumer Credit Act and the policy objectives underpinning those proposals. I'll give you a clear, practical overview of what is changing by addressing first the background to the CCA, why reform is needed, why it's being pursued now, and the legislative objectives. And I'll also look at the likely practical impact on firms and consumers, and finally the next steps and the preparations that firms might be able to make now. Starting with the background, it's important to understand the history of the Consumer Credit Act in order to place the proposals for reform in the correct context. The CCA in 1974 was a landmark statute. It created a comprehensive framework for the regulation of consumer credit and consumer hire products, including things like personal loans, conditional sale and hire purchase agreements for cars and household goods, and also credit and store cards and bank overdrafts. The statutory framework operated to control the entire lifespan of the product, essentially from cradle to grave, so pre-contract negotiations, the advertisement of credit and hire products, the supply of pre-contract information, the form and content of agreements, assessment of creditworthiness, and also post-contractual matters such as the right of cancellation and withdrawal, and control of how these agreements would be enforced against customers. The CCA also created real, and in some cases draconian, sanctions visited upon lenders who did not comply with the regulatory regime. In certain circumstances, a compliance failure can affect the enforceability of a regulated agreement, or require a court order for enforcement, or can prevent a creditor from recovering interest or default sums from a customer. I mentioned at the top of this webinar that anything connected with the CCA is usually very complex and takes a long time. The CCA was enacted in 1974. Since then, there's been a lot of tinkering with the Act, but no moves to effect wholesale reform. There were certain amendments in 2006, and some very messy amendments followed in 2011, when the government implemented the European Consumer Credit Directive, and this produced a tedious and at times utterly incomprehensible series of bolt-on regulations and orders amending little bits of the Act. There was further reform in 2014 when the Financial Conduct Authority took over as the regulator of the Consumer Credit Act, and this meant that where possible, the Consumer Credit Act was uncomfortably squished and shoehorned into a very different regulatory regime that flows from the Financial Services and Markets Act and the rules and principles-based system of FCA regulation. The result is a complex and at times confusing and utterly illogical patchwork of legislation and rules spread across the CCA itself, myriad sets of regulation, the Financial Services and Markets Act, the Regulated Activities Order, and the rules spread across the FCA handbook. Different rules and different requirements apply to different types of agreement. All of this demands a high degree of specialist knowledge properly to navigate the correct route and apply the correct legislation to the correct type of agreement. There have been previous attempts at reform, but really all of these attempts have simply operated to kick the can down the road. In May last year, 2025, HM Treasury launched its Phase 1 consultation on reform of the CCA. A further Phase 2 consultation was expected, and this is why last month's policy statement has generated so much surprise, because in that statement, HM Treasury decided that it actually had sufficient information to press ahead with its plans for reform and scrapped the plan for the Phase 2 consultation. Therefore, the timetable has now been accelerated somewhat. The government's central concern, and I set this against the background that I've just related about how confusing the patchwork of legislation actually is, the government's central concern is that the CCA is no longer fit for purpose. It is not fit for modern methods of communication, and indeed in the Treasury's own words in its Phase 1 consultation document, it describes the CCA as prescriptive, confusing and duplicative, complex and inflexible. To put the 1974 Act into some form of socio-economic context, when it was first enacted, the first credit card, and of course credit cards are controlled by the Consumer Credit Act, but the first credit card had only been introduced into Britain a few years beforehand. Moreover, the right to cancel a Consumer Credit Act agreement under Section 67 of the Consumer Credit Act was deliberately constructed to protect housewives accosted by doorstep salesmen flogging household goods on TIG, so as to give the housewife a right to cancel when her husband got home in the evening and told her to send everything back. We obviously now live in a very different commercial and technological world. In my view, the Act has actually weathered quite well, given how many technologies were not even invented at the time of the Act. Nevertheless, the two biggest challenges that now render the CCA no longer fit for purpose are the proliferation and widespread use of financial products, and secondly, the way in which the customer accesses those products through apps, websites, digital wallets, embedded finance journeys, comparison sites, point-of-sale finance, and motor finance platforms. It has become increasingly difficult to bend a statutory regime based on highly prescriptive rules and often demanding paper-based communication to the relentless march of technology and innovation. The key legislative purpose, therefore, is to modernise the framework and make it much more flexible. Essentially, reform will shift where the rules sit and how they operate. Instead of relying heavily on primary legislation and detailed secondary legislation, it's now clear that many requirements will be moved into FCA rules. The plan is that this should allow the FCA to respond much more quickly to change and adjust it and adapt its rules much more quickly than Parliament could amend the required legislation. So, moving on to the detail of the reforms required or proposed, the first point to make is that presently there is no change anticipated to the regulatory perimeter. The key definitions and concepts are proposed to remain the same. Therefore, the scope of the consumer credit regulatory regime and the consumer hire regulatory regime is expected to remain the same. The types of credit and hire agreement that fall to be regulated and fall to be exempt, there's no anticipated change to those descriptions or categories. Certain sections of the Consumer Credit Act will remain on the statute book. In the policy statement, the Treasury has stated that the current definitions of credit agreement, the meaning of credit, both at sections 8 and sections 9 of the Consumer Credit Act, those sections will remain on the statute book. Additionally, the key concepts that underpin so much of the Act, such as fixed sum credit, running account credit, debtor-creditor supplier agreements, debtor-creditor agreements, restricted use and unrestricted use credit. All of those sections of the CCA, currently at sections 10 to 13, and also section 19, which covers linked transactions, all of those sections will remain on the statute book. Equally, the definition of a regulated hire agreement at section 15 of the Consumer Credit Act, that will also remain on the statute book. The only section where there may be some change, and this is hinted at but not fully articulated in the policy statement, are the provisions of the CCA that currently relate to credit tokens. A credit token basically means a physical token, such as a debit card, a credit card, a store card, and when the Act was first introduced, things like gift vouchers. As I say, at inception of the Act, this usually meant a physical instrument. However, with the modern proliferation of digital wallets and virtual cards, the provisions of the Consumer Credit Act relating to credit tokens are now wholly outdated. Moreover, in relation to the use of digital and virtual cards and tokens, there's an overlap in certain circumstances with the Payment Services Regulations and the Electronic Money Regulations. And indeed, there's actually some confusion as to whether the Consumer Credit Act concept of a credit token extends to electronic tokens such as virtual cards and electronic wallets. But that's for another day. Presently, the policy statement indicates that all the provisions of the Consumer Credit Act relating to credit tokens and the supply of information and rights relating to credit tokens will be repealed. They may be recast into FCA rules where not already covered by the Payment Services Regulations. However, this is where it gets a little bit interesting, and this was not trailed in the Phase 1 policy document. The government has indicated in its policy statement that it will be undertaking further work on integrating relevant protections into the Payment Services Regulations, and it will look closely at the interaction between its ongoing work on the Payment Services Regulations and reform of the CCA. This statement is sort of left hanging there, and I may be reading too much into it, but it's possible that we could see a shift of control of credit tokens wholesale from the Consumer Credit Act into the Payment Services Regulations. I should stress at this stage that there's no real detail on this proposal yet, and it does sort of beg the question that where one has a credit token that's linked to an underlying credit facility, such as a credit card, whether wholesale control of that facility would move, or whether it would just be the use of the credit token with the credit facility separately regulated by the Consumer Credit Act or under FCA rules. However, all of that is currently speculation on my part, but this is definitely a potential change that requires monitoring going forward. The next area for change, which is not entirely unexpected, is that the form and content of pre-contract information and the agreements and other documentation to be provided to a customer in connection with a regulated agreement, all of those requirements are going to be repealed and recast as FCA rules. So in practical terms, this means that sections 55, 60 and 61 of the Consumer Credit Act, which enabled the regulations that prescribe the form and content of agreements and other communications and documents with customers, those sections will be repealed and will be recast as FCA rules. Additionally, the very complex rules at sections 62 to 64 of the Consumer Credit Act, which regulate the supply of copy documentation to a customer and wholly depend on whether the agreement is executed or unexecuted, all of those complex provisions will go and will also be recast as FCA rules. Additionally, Section 82 of the Consumer Credit Act, which governs modifying agreements, that will also go and will be replaced by FCA rules. The recasting of the modifying agreements regime as FCA rules, and obviously it depends on what those FCA rules are, but that will have many people very happy, because modifying agreements, which basically govern how you amend or vary a regulated agreement after it's been made, those provisions are very complex and lots of people will be very glad to see the back of them. I've mentioned several times now that certain provisions of the Act will be recast as FCA rules. At this juncture, I should take the opportunity to say that the FCA obviously needs to draft those rules and it needs to consult on the same. So whilst the framework legislation envisaged by the policy statement to actually repeal all these provisions, whilst that legislation will be currently making its way through Parliament, the FCA still needs to produce draft replacement rules and also consult on them. So there is some way to go before all of this becomes live. Anyway, getting back to the detail of the proposals for reform, the next point is that the rights of cancellation and withdrawal, currently set out at Section 66A and Section 67 of the Consumer Credit Act, which relates to the right of the customer to withdraw or cancel their regulated agreement after it's been made, those rules will be repealed and will be recast as FCA rules. Again, this will be the source of joy to consumer credit firms and practitioners, because the cancellation and withdrawal regime is, again, very complex. It depends on the particular type of agreement as to which section of the Act, 66A or 67, currently applies. There's a different regime flowing from Section 58 of the Consumer Credit Act for cancellation or withdrawal from agreements secured on land. And also, there are other statutory rights of withdrawal that can apply to a regulated agreement, where that agreement is entered into as a distance contract or over the telephone. And the FCA rules set out in the Consumer Credit Sourcebook at Section 2.7 are also relevant to the content of the information that a customer must receive about their right of cancellation or withdrawal of a distance contract. The precise right of cancellation or withdrawal that will apply, as I say, depends on the precise nature of the regulated agreement. And it's been a long-standing complaint within the consumer credit industry that it is challenging and costly to navigate this complex landscape and to apply the correct right of cancellation to the correct type of agreement and to provide the customer with the correct form of cancellation rights in the correct way. The feedback to the government Phase 1 consultation stated that some consumer groups would like simpler, clearer and more consistent requirements, and obviously the consumer credit industry will welcome any reform that makes this landscape easier and simpler to navigate. What is clear is that the consumer's right to change their mind within a reasonable period when they take out a product, that right will be retained and protected. So the government currently considers that these rights will be recast as FCA rules. Possibly the most welcome reform will relate to the changes to the post-contractual information requirements. Post-contractual information requirements embrace the supply of items such as annual statements of account, information notices to be given to the customer when they fall into arrears that absolutely notorious notice of sums in arrears, and default notices and notice of default sums. The statutory provisions and regulations relating to the form and content of these post-contractual documents and statements and the timeframes within which they must be given to a customer are notoriously complex and at times utterly impossible to navigate. The sanctions for getting things wrong are draconian and mean that whilst a lender is in non-compliance with the requirement, for example, to send a compliant notice of sums in arrears or compliant annual statement, they're unable to enforce the agreement against the customer, and they are unable to recover interest and default sums. These provisions have caused many lenders no end of problems, and we will all be very glad to see the back of these requirements. The current proposal is that sections 86B to 86D will be repealed, section 87 will be repealed, and will be replaced by FCA rules. We can only hope that this is not going to be a case of out of the frying pan and into the fire. Moving on, in terms of the post-contractual rights of termination and early settlement, the concept of protected goods will remain on the statute book. Therefore, sections 90 to 91, which protect the customer in the face of a lender seeking to repossess goods that are on hire purchase or conditional sale, those protections will remain in place. The right of the customer to terminate an open-ended credit agreement and the right of the customer under section 99 of the Consumer Credit Act voluntarily to terminate a regulated hire purchase or conditional sale agreement in circumstances where the customer has paid at least half the total amount payable, those provisions will be repealed and will be replaced by FCA rules. Similarly, the statutory right of a hirer under a regulated hire agreement to terminate that agreement under section 101 of the Consumer Credit Act, that will also be repealed and replaced by FCA rules. Again, it's clear from the response to the Phase 1 consultation that many industry and consumer groups broadly agreed that the principle of allowing early settlement and voluntary termination is an important consumer right to ensure flexibility and fairness. However, again, in common with the theme of this webinar, stakeholders on all sides raised concerns about the complexity of the legislation and the confusion that it sometimes causes to consumers. Therefore, as I say, these provisions are going to be repealed and replaced by FCA rules. I mentioned a few moments ago the post-contractual information requirements and the very high cost of non-compliance with those requirements visited upon lenders, which meant that a lender was unable to enforce an agreement or recover interest or default sums whilst they were in that period of non-compliance. The existing Consumer Credit Act contains powerful sanctions for certain breaches. These include unenforceability without a court order, temporary unenforceability until a breach is remedied, and, as I've already mentioned, the disentitlement to interest and default sums. To huge sighs of relief throughout the consumer credit industry, the government's approach is to repeal those sanctions where they attach to information requirements that are themselves being repealed and recast. Hence, the sanctions for non-compliance with Section 77A and Section 87 and Section 86, all of that will go because all of those information requirements are being repealed and will be replaced by FCA rules. This actually, in my view, is likely to be one of the most important changes for practitioners, particularly in relation to litigation, recoveries and compliance risk. It may reduce technical unenforceability arguments based on the failure to comply with prescribed wording or the failure to comply with certain formalities. However, I would stress that this does not mean that poor disclosure suddenly becomes risk-free. These provisions will be recast as FCA rules, and the FCA will still have supervisory and enforcement powers in order to police the quality of firms' documentation and procedures. Consumers can still complain to the Financial Ombudsman Service, and firms will still need to show good customer outcomes in accordance with the requirements of the Consumer Duty. And actually, it's quite important at this stage to pick up on the Consumer Duty, because this is a pervasive theme throughout both the Phase 1 consultation and the policy statement, that one of the intended platforms for reform is to align the regulatory regime with the outcomes demanded by the Consumer Duty, and effectively to use a firm's obligations under that Consumer Duty to enforce compliance with the wider consumer credit regulatory regime. Again, we'll have to see how this translates into the FCA rules that ultimately enter the Consumer Credit Sourcebook. Moving on to the criminal offences currently contained in the Consumer Credit Act, the government's indicated that the existing Consumer Credit Act criminal offences will be retained. These cover particular harmful practices, including canvassing off-trade premises, certain matters relating to credit reference agencies and pawnbroking, and the provision of information about goods by debtors and hirers. The rationale here is deterrence. Some conduct is considered sufficiently serious so as to justify continued criminalisation. In relation to all the provisions that I've outlined that are going to be transposed into FCA rules, the government has made clear that it's not the intention that there's going to be a simple copy and paste of the existing statutory provisions into rules in the FCA handbook. The FCA will consult on its new rules in due course. Those rules may be different from the current statutory provisions and may offer slightly different protections. The intention is that those rules may be shorter, more flexible, and, in the language of the Consumer Duty, more outcomes focused than the current statutory provisions. I think the one thing to underline here is that in thinking about how to prepare for reform, firms cannot just assume that it will be a matter of taking their current template documentation and their current policies and just making a few tweaks here and there to change cross-references or change headings or the way that things are described. I think it will be necessary for firms to review customer journeys, the design of communication, the mode in which those communications are delivered, and systems and controls and record keeping in order to effect compliance with the new rules-based regime. It's also clear at this stage that the actual form of regulated credit and hire agreements, together with the requisite pre- and post-contractual information documentation, is also going to look very different and, I hope, less complex than the current statutorily prescribed forms of those documents. Moving on, there are some provisions of the Consumer Credit Act that the government has made clear that it's, well, basically just not going anywhere near at this stage because it's all too complex, and that they will probably look at these provisions in due course. The provisions that won't be touched for now and therefore will remain on the statute book are Section 56 of the Consumer Credit Act that relates to antecedent negotiations. Essentially, that refers to the pre-contractual negotiations that a customer may have before entering into a regulated agreement. Connected lender liability at Section 75 and Section 75A, that's proposed to remain on the statute book for now. And also the unfair relationships provisions at Section 148 to Section 140C of the Consumer Credit Act. Those provisions will remain on the statute book untouched for now. I must confess surprise, actually, to the retention of the unfair relationships provisions. I had quite anticipated that those provisions might go on the basis that many protections can now be found with the overarching consumer duty that firms owe to consumers. However, it's obviously felt at government level that even though there may be some duplication with the protections offered by the unfair relationships provisions and the consumer duty, that the concept of an unfair relationship must remain on the statute book for now. Before I move on to the practical implications, it's worth noting that the regimes for credit promotions, i.e. the financial promotion of credit and hire products, and the regulatory regime that pertains to credit broking, both of those areas are going to be subject to specific review and consultation in relation to proposed change. In conclusion then, and moving to the practical implications and what firms might do to prepare for reform, I think that the proposed reforms can be seen both as an opportunity and a challenge. The opportunity is the prospect of a more flexible and accessible framework that's going to better adapt to innovation and the use of digital channels to streamline customer journeys, to streamline the way in which products are accessed and delivered to and by customers. Hopefully this will support innovation, and hopefully this will support clearer communication. The challenge, of course, is that rules-based regulation can be less certain than the current highly prescriptive regime that's contained on the statute book. Sometimes firms will be required to make judgments or test consumer understanding in terms of how these rules should be interpreted. And of course, again, bearing in mind the overarching theme of the consumer duty, they will need to be able to evidence consumer understanding and evidence that whatever the implemented approach may be, that it works in practice. There will obviously be a lot of work required to systems, controls, policies and documentation in order to transition to the new regime. Ultimately, I think in terms of what compliance teams can now do is to map the consumer credit obligations across the full customer life cycle: financial promotion, pre-contract disclosure, product delivery, contract documentation, post-contractual information requirements, default enforcement, complaints, redress. For each obligation, I think firms can now start to map out what's going to be repealed, what's going to be replaced by FCA rules, so that at least then there's a roadmap of those areas that are going to require attention going forward. In terms of the risks or challenges for litigation and recoveries team, the removal of some of these statutory sanctions may change the risk profile of technical unenforceability disputes. However, there will be transitional provisions, and so existing agreements and historic breaches and claims arising before commencement of the new regime will need some careful analysis once the transitional regime is revealed. In terms of the FCA's approach, They've stated that their approach will be underpinned by the consumer duty, which sets our expectations for firms to deliver good outcomes for consumers. As part of our policy development, states the FCA, we will consider existing consumer rights and protections, including, for example, cancellation and withdrawal and termination of agreements. Any proposals would be supported by evidence, including a cost-benefit analysis and stakeholder feedback. In conclusion, the reform of the Consumer Credit Act represents a significant structural change. The likely direction is repeal of many provisions of the Act, recasting of key requirements into FCA rules, the removal of certain statutory sanctions, and greater reliance on outcomes-based regulation and the consumer duty. I'd urge firms not to wait until the final rules are in force, but as I've already mentioned, it is possible now to start to map out the areas that will be affected by the proposals for reform. The shape of the regime is becoming clearer, and preparation can begin now. That's it. Thank you for watching. And should you have any questions, please do not hesitate to get in touch with me or my clerks, Jo State and Charlotte Blair. Thank you.